going on, everyone? It's Andre from Quicks Monday. Today we're going to be looking at how to use the EMA ribbons with our technical analysis. So we have a chart of Bitcoin right now against the GBP, and we see here that there's a bunch of lines. So what do each of these lines represent? Well, we have a 10 period, 20, 30, 40, 50, 60 period exponential moving average. Now, what do these tell us? These tell us the momentum of price action. So a good way of looking at it is, if we look at this run up here we had back in January, we ran and we extended far away from the moving average. And typically, price will retract back to a moving average of some sort, right? It goes back to its average point, boom, and then it bounces off here. Now, the bigger retracements will more than likely bounce to the longer period moving averages, such as the 50 or 60 EMA lines, especially with Bitcoin. Each asset class behaves differently around different moving averages. So just because the EMA ribbon 10 to 60 period works well with Bitcoin doesn't mean it's going to work well with, S&P 500 futures contracts, or, trading your traditional stocks or penny stocks. So in this case here, if we are seeing a full pullback, then we could potentially see price come down to these two levels here, as we previously saw here, right? That's what the EMA ribbons can prepare us for, or specifically moving averages. We don't necessarily have to use an EMA ribbon. Maybe your setup is just the longer term trend. So maybe you're just looking at the 10 period moving average and the 50 and 60 period moving average, or maybe you don't have that at all on your chart. Maybe you just have this on your chart to kind of tell you roughly, okay, where can we kind of see the price perhaps hitting back. Let's change the color on these so it can help illustrate the point here. Right, so this can help us determine, well, we saw in the previous performance here, went back down to test this area, goes back down here, comes back down to test this area of support, and we can probably assume that the same is happening here, more so that the lower highs are forming. So just based off of this chart, I can probably say that because we're starting to top out here, starting to form lower highs, that more than likely we are in for a retracement down to this area of dynamic support, right? And, we have seen this behavior before, right? Lower high forming and then down, a W pattern down, right? We saw it here, lower high forming, then W down, back to the dynamic area of support. So that is one pretty good way of using them on the daily time frame. Now, if you're using multi-time frame analysis, you must convert your moving averages to that time frame analysis. So what do I mean by that? So for example, let's say you use daily time frame and then you are moving on to your 12-hour time frame. This moving average is now not what you saw on the daily time frame, so you have to convert it. So now that there's twice as many candles, there's two candles now representing one day, so now you have to extend the time periods of each moving average by 2. So now your 50 period exponential moving average now becomes your 100 period exponential moving average. And the same, let's fix that. And the same with your 60 period, now that becomes 120 period moving average. And now that you've converted your exponential moving averages to the correct period count, you have an accurate representation of the same dynamic support region that we saw in the daily time frame. But now you have more candles, more information to work with, right? You have 2 candles now per day. That is how you correctly convert your moving averages across multiple time frames. I see a lot of traders just switch time frames and they don't bother changing the periods on their exponential moving averages. And this can be when you trade, your mind is in tune with your moving averages. Once you have a setup figured out, you don't necessarily want to change it, and you want that setup to be consistent throughout all your time frames, right? That's how you correctly do. That is the correct approach to multi-time frame analysis, right? Your indicators stay the same, but you're seeing each time frame on a smaller perspective, on a smaller picture, right? So you want to make sure all your lines and all your indicators remain in the same spot, in the same place, but you're just getting a smaller, more accurate view of what's actually going on. That'll wrap up today's video, and I hope this helps you build your arsenal of tools and indicators as a trader. Keep in mind, I'm not a financial advisor, and this is only my personal opinion, and I'll see you guys later. Peace!